It's a chilly morning in late December 2025. Unseen by most, three alarms begin to ring in unison across the global financial system. The first alarm goes off in New York. The stock market, a pillar of global wealth, has just quietly crossed a line it was never supposed to cross. The S&P 500 Shiller-Cape ratio, a measure of long-term valuation, ticks past 39. To put that in perspective, it is higher than the peak just before the Great Crash of 1929. It is even higher than the fever pitch of the dot-com bubble in 2000. It is a silent siren screaming that stocks are detached from reality. At the very same moment, a second alarm echoes through the canyons of empty office towers across America. Commercial real estate, the kind of buildings that define our city skylines, is in a state of quiet collapse. Properties once collectively valued at a staggering $180 billion back in 2021 are now worth barely half that. But here's the scary part. On the books of the banks that financed them, these buildings are still listed near their peak values. The losses are real, they are massive, but they remain hidden, papered over, and completely unrecognized. It's a ghost loss haunting the financial system. But the third alarm is the loudest of all, and it's sounding in the bond market. Imagine a giant wall of debt coming due. Over the next 24 months, a mind-boggling $13 trillion in corporate debt must be refinanced. Think of it as a giant credit card bill for corporate America. The problem, that debt was taken out when interest rates were near zero. Now, it has to be rolled over at rates that are 2 or even 3 times higher. For many companies, this isn't a challenge, it's a death sentence. A massive wave of defaults is no longer a possibility, it's a mathematical certainty. So what makes this scenario, this potential crisis of 2026, so different from anything we've seen before? In the past, financial crises were often contained. In 2000, it was the tech bubble. In 2008, it was the housing market. But this time is different. These are not isolated problems. The stock market, commercial real estate, and the corporate debt market are not failing independently. They are tangled together in one tightly connected, interwoven system. Think of it like a series of dominoes, all set up and ready to fall. Stress in one area doesn't just stay there, it instantly spreads to all the others. Let's walk through how this chain reaction unfolds. The sky-high stock prices we see depend on strong corporate earnings to justify them. But where do those earnings come from? For over a decade, they've been fueled by cheap and abundant debt. Companies borrowed money for practically nothing to buy back their own stock, fund expansion, and boost their profits. But that era is over. Cheap debt no longer exists. As companies are forced to refinance their old loans at these new, much higher interest rates, their expenses will explode. Suddenly, a huge chunk of their revenue that used to be profit now goes straight to paying interest on their debt. And what happens when profitability collapses? The entire justification for those record high stock prices evaporates. Stock prices begin to fall. This isn't a gentle decline. As stocks fall, it triggers margin calls. Investors who borrowed money to buy stocks are forced to sell to cover their loans. This forced selling creates a downward spiral. More selling leads to lower prices, which triggers more margin calls, and even more selling. This panic doesn't just stay in the stock market. Desperate investors start selling whatever they can, and that selling pressure spills over into other assets, like real estate and private investments. Now, remember those empty office buildings and the hidden losses on the bank's balance sheets. As the broader real estate market crashes under the weight of forced selling, those hidden losses can no longer be ignored. They become real, tangible, and catastrophic. Banks are forced to write down the value of these assets, which in turn destroys their balance sheets. And what happens when banks start taking massive losses? They do the one thing that grinds the entire economy to a halt. They stop lending. This is called a credit freeze. Suddenly, even healthy businesses can't get the loans they need to operate, to make payroll, or to invest. Without access to financing, they have no choice but to start laying people off. Layoffs surge, unemployment rises rapidly, and the real economy, the one that affects you and me, begins to seize up. This isn't just one bubble popping. We don't just have a stock bubble or a housing bubble, we have an everything bubble. 14 years of near-zero interest rates and unprecedented money printing by central banks didn't just inflate one asset class. It inflated every single asset class, all at once. Stocks, bonds, real estate, private equity, even cryptocurrency, everything was pushed to extreme valuation simultaneously. History has never, ever seen a moment where all assets are stretched this far, this thin, all at the same time. This is the most crucial point to understand. In past crises, there was always somewhere for investors to hide. In 1929, as stocks collapsed, government bonds held their value, providing a safe haven. In 2008, as the housing market imploded, bonds and gold offered protection. You could diversify your portfolio. If one part went down, another part would go up, or at least stay stable. But in the crisis of 2026, there is no such shelter. This time, diversification fails. When stocks fall 60%, bonds are also falling 40% because of rising interest rates and inflation. Real estate is falling 50%. When everything falls at once, the very concept of a safe asset disappears. There is nowhere to hide your capital. Trillions upon trillions of dollars in global wealth are simply erased, all at the same time. Now, it's very important to state that this is not financial advice. This is an exploration of systemic risk. It's a warning about what can happen when the entire system becomes fragile. When every single asset class is simultaneously overvalued and leveraged with an unprecedented amount of debt, the corrections that follow, not healthy or normal, they become cascades of destruction. It's not one bubble bursting, but 7 or 8 bubbles all collapsing together into one single, monumental event. And once that timeline starts, once the first major domino falls, the chain reaction may be impossible to stop. We've built a financial system more interconnected and more leveraged than ever before. We've enjoyed the ride up, but we must also be aware of the risks on the way down. Thanks for watching, and remember to think critically about the world around you. Follow for more insights.